Good day, fellow investors. In this video I want to share Warren Buffett's most remarkable investing performance because there is so much to learn about it. Yes, I want to share his.
For some time, stocks have been rising at rather rapid rates. Corporate earnings have not been rising. Dividends have not been increasing. And it's not to be unexpected that perhaps a correction of some of those unusual factors on the upside might occur on the downside.
Investment performance. So, maybe you don't know, but Buffett first purchased Berkshire Hathaway at $7 in 1962. He bought it because the liquidation value was 19, so it was a pure Graham-style value investment. He wanted to sell his stocks to management for $11.50. They said yes, and then they lowered the price to $11.47. He got really pissed and took control of the company by buying 49% at an average purchase price of 14 something in 1965. The purchase price was 14, but the stock hit a low of 13 and then went to 39 in 1968. 8 years later, so from 68 to 1976, Berkshire hit a low of 38. So no dividend, $1 down after 8 years. And now you're thinking, Sven, you're talking about the most remarkable performance of Warren Buffett. 8 years, he was $1 down in a bad market. Of course, the high was 93 in 1973, so he was down, what is this, 75% in 3 years. That's Warren Buffett. Yes, even Warren Buffett was down that much. And if you look at what he owned back then, the textile operation, so it was bad from a return of capital performance. This is the last letter to his limited partnerships, but he kept it because there was some capital. He didn't want to fire the people, but the capital that was free was successfully redeployed in insurance, Sun newspapers, National Bank and Trust Company of Rockford, Illinois, and that's what Warren Buffett did. And while he was doing that, redeploying capital, in 1983 the stock hit 1,385. The Dow from 1965 went nowhere, only dividends of 3-4%. Berkshire went up 53 times. And that's what I find the most remarkable performance. I'll show it again in charts. Let's see this. So this is the Dow, 100 years of history. Let me disconnect the inflation adjusted. And you can see that the Dow went practically nowhere from 1965 till 1982. So it was close to 1,000, and here it was still at 1,000. This is 1968 till 1982. Okay, if we put 5% dividends over 14-15 years, okay, that's a double. So let's say the Dow doubled in 15 years. As we said, Berkshire went from 39 in 1968 till 1,385, or let's say 650 in 1982 over the same period, thus increased about 50 or even more times, 100 times, depending on where you calculate it. So what's the message here? That yes, everyone is saying you can invest in index fund, that's the best investment, that's the best investment. And then I'm looking at this. This is the environment that Warren Buffett destroyed everyone. It was an environment with increasing interest rates. Index funds were non-existing practically. Nobody wanted to invest in stocks. And then, of course, when interest rates started to go down, 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 and to zero and below, now everyone is exuberant about stocks. But it's easy to invest now when the tide is rising. But when the tide goes away, we'll see who is swimming naked. And certainly Warren Buffett wasn't swimming naked. He was accumulating during these bad times and building his long-term performance. And this is perhaps the most important thing. 8 years he was down. He was down 8 years of no performance or zero returns, he was down pretty bad, and then everything exploded from 1976, a low of, 38 to 1,385. That's a remarkable performance. But he's been working on that from 1964-65 since he acquired Berkshire. And that's the compounding, that's the investing I want to discuss with you. Okay, are you building the fundamentals of your long-term wealth, the compounding, the book value, the return on capital, the great business, the moats, the risk, the margin of safety, or you're just chasing stocks? I feel because of 40 years of declining interest rates, everyone is just chasing stocks because of the money printing, because of the money coming into your pocket with stimulus checks. Most people are doing that and not really investing. And you can see here how, of course, Buffett did bad in these years as the market also did bad. 48% down in 1974, and here in the next 10-20 years, the accumulation of capital, of good businesses, of high returns on invested capital made his explosion later. So this is Warren Buffett. This is what I really wanted to show you. And I think it is really what matters when it comes to investing. And it makes you think whether you want to be an index fund investor or just follow the trends, or you want to really build your core portfolio from the fundamentals up. Reinvesting dividends, buying good businesses with high returns on invested capital that are good no matter what the Fed does. That's what we do on this channel. That's the core educational point of this channel, and that's the core what we are looking for when we look for investments here. So if you are a fan of that, if you are thinking that it might contribute to your financial wealth long term, smash that like button and subscribe.